Reviewing sector performance is very critical in determining the sustainability of a market advance or a market decline. Taking a look at this example, this is the S&P 500. This is a weekly chart that dates back all the way to 2010. It goes all the way through 2010 and then into the first 4 months of 2011. But you can see there were a lot of ups and downs along the way. Made a big run from August 2010 through February of 2011. Things looked pretty good technically. A lot of different indicators supported that advance. But after going sideways for a while, we saw a breakout in the fourth week of April of 2011. And I wrote about this at Stock Charts in their Chart Watchers newsletter. I saw some warning signs, and we'll get into a number of those in other lessons. But in today's lessons, I wanted to just show you how important viewing the sector performance, taking a look at relative performance among sectors, and how that can impact a potential move to the upside. Now right here you can see we have a breakout at the 1345 area. The S&P 500 breaks out on a weekly basis to a new high. I'm sure CNBC and everyone else is talking about how great things are. You know, we've broken to a new high, couldn't be better. We're going to go a lot higher. I'm sure you heard all of that. But when I wrote back in April of 2011 about some of the warning signs, I want to show you what I was talking about. Now this is a relative strength chart. Down at the bottom, you'll see the S&P 500 all the way since 2010, all the way down, back up again, and then finally breaking out here in April of 2011. But I want you to take notice of some of the sectors that were leading this advance. From the February high to the April high, you can see that the S&P obviously moved to a new high. But look what happened with technology. Technology, now this is a chart of the XLK, which is an ETF that tracks the technology sector. And this is a line chart. This is just showing a ratio between the XLK and the S&P 500. So as the S&P 500 was moving to the upside, take a look at the fact that from a relative standpoint, technology was not leading this advance. In fact, it was lagging. Industrials were just mediocre, not really leading the advance. But when we looked at some of the defensive groups, or the three primary groups on the defensive side, consumer staples right here, utilities right here, and healthcare, you can see that on a relative basis, these three groups were actually leading to the upside and supporting this move on the S&P 500. Now the big problem there is that that's not normally the way the market works. What you want to see in terms of determining a sustainable move in one direction or the other, whether you're long or short, if you're long and the market's moving up and you want to determine whether or not that move is sustainable, one of the things you need to do is to look at the sector performance on a relative basis and see what is leading the market. Now, if you take a look at the August advance through February, you'll see that during this move to the upside, technology, that sector actually moved up throughout this period. Industrials moved up during this period. And the groups that were lagging, the three defensive groups, you can see their relative strength lines were coming down because each of them relative to the S&P 500 was underperforming. That's what you want to see in an advance. You don't want defensive stocks leading the market to the upside. You want the more aggressive sectors like industrials, technology, financials, consumer discretionary. Those are the types of groups that you want to see leading on a relative basis to the upside. If that occurs, then you've got a pretty healthy market. And you can see from September to February, that's exactly what we had. But by the time we broke out in April, you could see how the money had shifted. More and more money was actually flowing toward defensive groups. And that was a warning sign. That was one of the things that I wrote about. So what happened after April? Well, here you go. Here was the top, right at the end of April. We made this breakout. It was not being supported by the right groups. And as a result, it failed. We came back down, we made one more push, tried to get back up, never made it through the previous high at the end of April, early May, and then in August took a big hit to the downside. So while you can't always see with 100% certainty where the market is going, as traders, we all need to recognize the warning signs. We need to know when it's time to be aggressive in the market and when it's time not to be aggressive, when we need to kind of pull things back and let the market do its own thing. If the market kept going higher from this April high here, if we had continued moving up and we just failed to participate in it, so be it. The point is that we had signs. This was a major sign, major warning sign that this advance to the upside was not sustainable. It was being led by the wrong groups. And as you can see, it turned out to be the right signal as we fell back down.